everyone, Mike here, your private family banker, and I'm back with another episode. This is the last in my mini-series about debt elimination or debt reduction. And today I'm going to give you the top 6 reasons why private family banking is the most efficient way to eliminate consumer debt. In the previous 4 episodes of this mini-series, I introduced the idea. And then I discussed one of the biggest misunderstandings that people have about their consumer debt, which is that most people mistakenly look at the interest rate instead of looking at the volume of interest that they're paying. Then I walked through 2 different examples of people using the private family banking strategy in order to pay off their consumer debt. In the first example, someone paid off $111,600 in consumer debt. It would have taken them 6 years to do that, just making the regular payments. They did it using only $16,200 worth of premium payments, and they did it in 4.5 years. In the second, I showed you how someone paid off $701,000 in debt that would have taken 25 years to pay off. Instead, they did it in 18 years using only $608 a month in premium payments. Throughout those 4 episodes, I've built the case that private family banking is the most efficient way to eliminate consumer debt. And today I'm going to bring it home by highlighting the top 6 reasons that that's the case. Let's dive in. First, your debt is paid off early. In the 2 examples I gave, the private family bankers were able to reduce the terms of their loans from 6 years to 4.5 years and from 25 years to 18 years. That's at least a 25% reduction in term. Doing this puts you on the fast track to building wealth. Now, it might be difficult to wrap your head around such a long-term plan, especially the second one that takes 18 years. But remember, when you're using this strategy, you're playing the long game, and we set the whole plan up for you. Number 2, you convert high-interest loans to lower interest policy loans, which is going to reduce the volume of interest that you end up paying. And it's going to allow you to recapture that interest and get it going to you instead of to someone else. If you have a higher interest credit card debt or personal loan debt, this is going to certainly be the case. But even if you don't, and your mortgage is at, say, 3 or 4%, the volume of interest is going to be reduced. Again, the examples prove this out. In the first example, the family would have paid about $42,000 worth of interest over 6 years. Instead, 4.5 years, and they paid only about $28,000 in interest to other people. In the second example, the difference was $540,000 down to $320,000 of interest over the course of the 18 years. Now, when you get this interest coming back to you, again, it gives you the power to build wealth. Number 3, there's a minimal contribution required to accomplish a big goal. First, you're in control of how much of a contribution you make. We build a plan based on your ability to contribute to the policy. In the first case, it was $300 a month, which amounted to about $16,200 over the 4.5 years of paying premiums. But that allowed them to pay off $111,600 in debt. In the second case, it was about $608 a month. Over the 18.5 years, that amounted to about $132,000 in premium payments. But again, they used that in order to pay off $701,000 in debt. These numbers are incredible, and it's only possible because of the next reason. Number 4, you end up using the same money over and over. You use your cash value to pay off your outside debt. The result is that you now own the debt as opposed to someone else, and now you're in control. Then you use the loan payments that you were already making to someone else, and you use them to pay back the policy loan. And when you do that, you free up that same cash that you already used, and you make it available to use again. Number 5, you build a reusable pool of capital while paying off the debt. At the end of the debt reduction cycle, you'll have all of your outside debts paid off and have all of your policy loan paid off. At that point, your cash value is there to be used for other things that I'm going to get to moving forward. In our two examples, all of the debt was paid off and he had around $20,000 in cash value available. The second example, there was about $150,000 of cash value available. Now, this happens because of our last reason. Number 6, your cash value continues to grow while you use it. Find another vehicle out there that allows you to use the same pool of money more than once while allowing that pool of money to continue growing while you use it, and I'll listen. Until then, I'm going to continue to say that private family banking is the most efficient debt elimination tool out there. All right, that's it for today. Please like and subscribe, share this with a friend, and I'll see you next time. Until then, out.